latest consumer price and producer price inflation figures from America will doubtless grab a lot of headlines on Wednesday the 12th and Thursday the 13th of July, respectively. CPI inflation was 4.1% in May, the lowest figure since April 2021, while the producer price index, or PPI, rose by just 1.1%, and that was the slowest rate of increase since December 2020. That cooling PPI number offered some hope that lesser input cost pressures would help the headline rate of CPI further down the road, and may have informed the US Federal Reserve's decision to pause an interest rate at 5.25% at the June meeting. However, an even more important number is due for release on Tuesday the 11th, and that is the American NFIB survey, which asks smaller companies for their perspective on the world. Over 33 million American businesses employ less than 500 people, and their staff represent a mere 99% of the total US workforce. So this survey provides an invaluable insight into a key component of the US economy. There now seems to be a gathering consensus that America may suffer no landing at all, let alone a soft or a hard one, a shallow or a deep recession, and therefore defy the pessimists by continuing to grow. The bad news, therefore, is the last NFIB reading was 89.4. So what, you may say, but that was the lowest score since January 2013, lower even than the level seen during the 2020 pandemic panic. A drop below 95 heralded the recessions of 1990, 2007 and 2020, while the NFIB indicator got to 96 out of the 2001-2 downturn. The only really false signal it's given when it's gone below 95 came in 2016. And US small caps are in fact reflecting some of this unease. The Russell 2000 index is still down by more than a fifth from its high and is therefore technically stuck in bear market territory. An upturn therefore in the NFIB and the Russell 2000 would be a potentially encouraging indicator for any investor who's looking for further gains from US equities, where 2023's gains are, thus far, relying on a tiny number of stocks. A narrow breadth can be seen as a negative sign, not a positive one. On the corporate front, we're about to hit the second quarter reporting season in the USA. PepsiCo and Delta Airlines will be among the first to step up on Thursday the 13th. UK-quoted firms will also be relatively busy, as 7 FTSE 100 members are scheduled to release a trading update or host an annual general meeting for shareholders. Companies that may be worthy of note include the following, either because of what they say about themselves, their industry, the global economy more widely, although do note that some of these dates could yet be subject to change. National Grid on Monday the 10th of July, British Land, Grafton and Galliford Try on the 11th, Page Group, Tullow Oil, Sosandar and Renault on the 12th, Experian, Barratt Developments, BT, DCC, Watches of Switzerland and Hayes on the 13th, and Ashmore and Lion Trust Asset Management will round out the week on Friday the 14th. But the company which could really cause a fuss in the week ahead is Burberry. The luxury goods firm is scheduled to release a first quarter update for the 3 months to the end of June on Friday the 14th, 2 days after its annual general meeting. Burberry shares are up by a quarter over the past year, and that's even after a fairly rapid retreat from the all-time high reached in the spring. The gains of the past year owe at least something to a reopening China after 3 years of lockdown, as the country is a big consumer of luxury goods, and the recent slide may also be China-related, given how the country's economy doesn't seem to be picking up steam quite as rapidly as many people had hoped after the lockdowns. Now, Burberry's quarterly updates traditionally feature just headline sales figures plus some more colour on trading. As a result, all attention will focus on the headline retail sales number plus the like-for-like comparables. Analysts and investors will also look to weigh how these figures stack up relative to the medium-term targets outlined alongside May's full-year results by Chief Executive Jonathan Ackroyd. Now remember, the company is looking for this year, and indeed medium-term, high single-digit percentage revenue growth and an adjusted operating margin of around 20% on a constant exchange rate basis. Now that compares to 20.5% last year, and analysts are currently expecting total sales at $3.3 billion and a stated operating profit of around $650 million. And that's with a forecast $70 million hit to sales and $40 million to profit from currency movements. Adjust for those, an operating profit seen around $690 million for a margin of 20.6%. In terms of sales, Burberry reported retail revenue of £505 million in the first quarter a year ago. That was a 5% increase on the period before that on a stated basis, and flat using constant currencies. For fiscal 2024 overall, Analyst consensus sales forecast of $3.3 billion, and that implies sales growth of 6%. Analysts and investors will also look for further colour on online versus physical sales, pricing and input costs, and regional sales trends between Europe, Asia and America. In fiscal 2023, Europe, the Middle East, India and Africa are up 23% between them, Asian sales rose 2%, and revenues in Americas fell 3% on a comparable same-store basis. Group sales excluding mainland China rose 14% compared to the actual 7% growth rate generated last year. As a final point, remember that Burberry is currently running a £400 million share buyback programme, which is due for completion during this fiscal year, so any updates on that and capital allocation policies will be welcome. Thank you for watching. I hope that you and your families are all well and in good spirits, and I look forward to chatting to you again next week.